Good morning, everybody. Now we are going to go ahead with the next module, that is investment decision. So far in financial management, we studied the introduction to financial management, we studied the objectives of financial management, then we went on to study what is time value of money. We tried to use time value of money, that is the future value as well as the present value. Then we went on to do the cost of capital, which was related to the financing decision. We tried to calculate the individual or the specific cost of capital, and then we also calculated the overall cost of capital, that is WACC. Okay. Now we are going to go ahead with the next decision. Okay. If you remember, finance manager takes three types of decision. First is the financing decision, that is collection of capital, which we studied through cost of capital. Second is investment decision, that is the amount that he has collected, now the capital that he has collected, and he is to invest it somewhere. So where do we invest it? Now, whenever a company invests, it doesn't have a single option or opportunity. It has varied opportunities, or there are multiple options where a company can invest. Now, where should it invest? Should it invest in project A? Should it invest in project B? Or should it invest in project C or D? It depends on certain criteria which are given by this investment decision. Now, investment decisions can be further divided into methods of two types. Okay, these methods are further divided into non-discounted methods and discounted methods, or we also call it as traditional methods and modern methods. Okay, so let us understand what is the difference between this discounted and non-discounted and discounted method. Okay, non-discounted methods are the methods which do not use time value of money. I am repeating, non-discounted methods or the traditional methods are the methods which do not use the time value of money. Okay, these do not use the time value of money. Whereas the discounted methods uses the concept of time value of money. So they use time value of money. Okay, so this is the basic difference between what is non-discounted methods and discounted methods, also called as traditional methods and the modern methods. Okay, so let us understand what are the various non-discounted methods. The various non-discounted methods are, first one is payback period. Okay, briefly I'll just explain you what these methods are. Further, when we are solving problems, we'll be understanding these methods in detail. Payback period is the period within which you get back your investment, in simple words. Okay, the period that is required to get back the amount that you had invested is called as payback period. It is also called as PBP. Next one is the accounting rate of return, or also called as the average rate of return or return on investment. Okay, so it is the percentage of returns that you're getting on your investment. So if you invest X amount, how much returns are you getting in terms of percentage is given by ARR. Okay, in simple words, it is average income divided by average investment. So that is called as average rate of return or accounting rate of return. Sometimes it is also called as the return on investment. Coming to the next part, that is the discounted methods. In discounted methods, we have the discounted payback period. So it's very much similar to the payback period. Only thing is, here we are going to use the concept of time value of money. Now, what do I mean by this concept of time value of money? That means whatever cash flows would be given to us, first we are going to find out the present values of the cash flows and then use them in these formulas. Okay, so discounting means finding out the present values of the cash flows. Okay, I am repeating, discounting means finding out the present values of cash flows and then using them in these formulas. Okay, that is what discounted methods talk about. So payback period, discounted payback period, the concept remains the same. Only thing is, here we are going to use, in payback period, we are going to use the cash flows as it is, what is given in the problem. Whereas in discounted payback period, first we are going to calculate the present values of the cash flows and then use it in the procedure. Okay, then coming to net present value. Net present value, briefly we have studied it during wealth maximization objective. Okay, so it is the it is basically the present summation of present values of cash flows after tax minus initial investment gives you the present value, net present value. Profitability index is basically if you invest 1 rupee, how much will you get back on that 1 rupee is given by profitability index. Net present value is basically if you are investing 100 rupees and how much are you getting back in terms of rupees is given by net present value. This is given in terms of 1 rupee. So if you invest 1 rupee, how much are you going to get back is given by profitability index. Profitability index is also called as benefit cost ratio. So sometime in the question they may ask you to calculate benefit cost ratio. So benefit cost ratio is nothing but profitability index itself. Coming to the next one is the internal rate of return. It is the rate of return at which the NPV would be 0. Okay, NPV would be 0. So this is the internal rate of return, and there is something called as the modified internal rate of return, which we are going to study. Okay, it's the modified form of this internal rate of return itself. Okay, so this was the theoretical aspects of what is investment decision, what are non-discounted methods, what are discounted methods, various non-discounted methods and various discounted methods. Now let's begin with solving or understanding these methods one by one. Okay, so the first one is the payback period. Okay, so the payback period, what is payback period? It is the time required to get back the amount invested. That is the most simplest definition that we can give. The amount, suppose I have invested 10 lakh rupees in a project, in how many years will I get back those 10 lakh rupees? That 10 lakh rupees is given by the payback period. Okay, so let's understand this using a particular problem. Okay, in this there are three types of problem that we come across. One is when the cash flows are not similar. Okay, we have to find out the present value. When the cash flows are uniform, we have to find out the payback period. So similarly we have to do these calculations in three different ways. So let's try to understand them one by one. Okay, first problem, for a given cash flows calculate payback period. Okay, so what is given to us? Years is given, that is 0, 1, 2, 3, 4, 5, and cash flows after tax are given, that is minus 10 lakhs. Anything in the bracket represents minus. So minus 10 lakhs, 20,000, 40,000, 40,000, 40,000 and 30,000. Okay, so in this case, first of all, are the cash flows uniform throughout the years? No, they are not uniform. They are different, that is 20, 40, 40, 40 and 30. They are not uniform. Okay, so I cannot use the formula. Second thing is, what is this zero period? Okay, always remember in investment decision, zero period represents the current period, that is the initial investment. Zero period is your initial investment. So what is your initial investment? It is 1 lakh rupees. Now the question is, why it is given in bracket? Why it is negative? Because it is outflow. Investment is outflow, so it is given as negative. Okay, just to make you understand. So zero period always represents initial investment. I am stressing on this point again and again. Okay, then let's do the calculations. Now since these cash flows are given, okay, we have to first find out the cumulative cash flows. I hope everybody knows how to calculate cumulative cash flows. Cumulative cash flows, okay, do not consider this year because that is the initial investment. Start from year 1. So 20,000, first year initial cash flow would be, cumulative cash flow would be 20,000 itself. Second year it would be 20 plus 40, that is 60,000. Third year it would be 60 plus 40, that is 1 lakh. Fourth year it would be 1 lakh plus 40, that is 1,40,000. And fifth year it would be 1,40,000 plus 30, that is 1,70,000. So this is how we calculate the cumulative cash flows. Now once we calculate cumulative cash flows, we have to try to find out whether this value is there in the cumulative cash flows. How much is the value? 1 lakh. So we have to find out 1 lakh in these cumulative cash flows. So where is 1 lakh? It's over here. It's corresponding to which year? It is corresponding to the year 3. So what is the payback period? It is 3 years. So wherever the initial investment lies in the cumulative cash flows, that particular year would be the payback period. Okay, this was the most simplest problem. The next problem, Okay, so I hope you're clear with the calculation of payback period when different cash flows are given when they are not uniform. Suppose the cash flows are uniform, that all the years the cash flows are same, then how do we solve it? Okay, for that let's go to the next problem. A project involves a cash flow of 5 lakh and it is expected to generate cash flows after tax of 50,000 every year. So what they have given here, they have said that the cash outflow is 5 lakh, that means the initial investment is 5 lakh and the project is going to generate 50,000 every year for 20 years. That means 50,000 is constant or it is uniform for 20 years. Okay, so if such cases are given, then we can directly use the formula of payback period. Now what is the formula of payback period? It is total investment, initial investment divided by annual cash flows. Okay, now again I am repeating, when can we use this particular formula? Only when the cash flows are uniform throughout the life of the project. Whenever they are uniform, that is they are same throughout the life of the project, then only we can use this particular formula. Okay, so what is the formula? Payback period is equal to total initial investment, that is 5 lakh rupees, divided by annual cash flows, uniform cash flows, that is 50,000. So 5 lakh divided by 50,000 gives you 10 years. So the payback period for this particular project would be 10 years. I hope you're clear with this calculation of payback period when the cash flows are not uniform and when the cash flows are uniform. Okay, we'll stop over here. In the next class, we'll study one more type of problem which we get in payback period, and then we'll continue with the next part of investment decision. Thank you.